All right, here is our beautiful 1120. We are going to get into C Corps, moving into C Corp territory. And the 1120, well, first off, memorize that that belongs to the C Corp entity type. And then the 1120S will be the S Corp tax return. But this is pretty much the only one that you're going to actually calculate and pay tax on, because all the other ones, you could say that they are for informational purposes, because the income will flow to the individual members, taxpayers, right? The shareholders, the partners, all those other entity types are going to flow through to the individual. Whereas here we have our gross receipts, all of these items, interest, right? This is all our income minus all of our deductions, expenses, all that good stuff. And then we're actually saying, okay, we're paying taxes on this, right? Here over here. This is our taxable income. We're paying taxes on it. And then we're going to distribute that to the shareholders. That is going to be something we'll see. Now we're going to talk a lot about corporations. We have a lot of corporation lessons. Is one more important than the other, right? Or corporations more important than partnerships or, anything like that? No, just we have different lesson types that are broken up. I mean, it's guidance from the AICPA, the way we have them broken up, and then we took it upon ourselves to break them up a little bit differently as well. I viewed it to be kind of the best way to learn. So we are going to dive into corporations, have a great time while doing it, get a smile on your face. If you don't have one, don't worry, I'll pop a few other awful jokes and we'll be on our way. Now, what are some factors of C Corps that we should be familiar with? First off, C Corps have articles of incorporation. So this is the name of the document that you need to file when you are filing for a C Corp. Now, take note, when we do talk about S Corps, remember, say this fact here and there, you form a C Corp and then you elect to become an S Corp. That's the process. Now, remember, S Corps cannot IPO. They cannot be public entities. The only type of entity you'll see on the New York Stock Exchange will be C Corps. All right, I lied. Well, I mean, if you type in stock tickers, you may find bond funds, investment funds, other type of things. But generally speaking, we think of just normal companies, right? Tesla, Apple, Microsoft, all those things. Those are going to be normal C Corps. Now, this is the document filed. Talks about the number of shares authorized to be issued. Maybe when it starts out, there's only 2,000 shares. And is there one or more class of stock? Is there a normal common stock? Is there a preferred extra super special VIP voting stock? So that is something that could exist. For example, Google has two classes of stock on the stock exchange. If you were not aware, one I believe is GOOG, and then one is GOOGL or something like that. So that is just something, tying this into the real world, kind of where you'd see these things. Bylaws for a corporation. These are the rules for running the corporation. They're not required to be filed with the state. Now, there are maybe other implications such as SEC requirements, but we're not really worried about that. We're talking more so about general attributes of a C Corp. We have shareholders, and they are not personally liable for the corporation's debts. Generally speaking, no one's liable unless you pierce the corporate veil, which means that you commingle funds, you start using partnership assets for illegal activities. Now, you could be personally liable, but for whatever you do. But if you're acting in the scope of the business, generally people are not going to be liable, which is why I think after the 2008 financial crisis, what was it? Only 1 or 2 people went to jail. Gotta love it. Great little time there. So double taxation, as we know, this is kind of the worst thing about them is that they are taxed at both levels. We saw that in our previous numerical example. Their life is that they can exist indefinitely. And there's a wonderful book, Sapiens, I read quite a bit back, a few years back, and it's kind of like the next stage in human evolution. C Corps can exist indefinitely. That's what he talks about in the book. And yeah, that's kind of human beings. We all pass on to live in paradise at the pearly gates with a margarita in hand. But for C Corps, they can exist indefinitely. Right to inspect the books. Now, I did hint to this a little bit earlier. Shareholders have the right to inspect the corporation's books. However, this is not that easy. Like I said, you can't just go and demand to see the books, right? The financial statements. But in essence, these are the financial statements. That's why they release financial statements every quarter, every year. For public companies, they are released quarterly. For private companies, there's a separate process because when we talk about C Corps, it's not always public companies. It can be private companies as well. That's something to take note of. And we'll talk as well about who can actually go and inspect the books. If I get bored one day, can I go and inspect the books? Nope. You generally need a purpose and a reason. You have to file to do so. And there's a couple other points that we'll talk about. All right, some more points here. It's managed by a board of directors. So the board of directors is responsible for appointing management. Management is C-suite, so CEO, CFO, CTO, all those great people. The board of directors is voted on by the shareholders. The board of directors deals with the general oversight of the entity. the long-term goals, whereas management kind of deals with the day-to-day operations. Not that management shouldn't have a long-term view, but management, the CEO, CFO, they deal kind of with the day-to-day, year-to-year with board of directors. More so is going to deal with the what's our 10-year plan. Shareholder ownership, well, as you know, as you can just buy and sell shares of a company, you can transfer your ownership freely. Yeah, I'd say when we deal with C-Corps, if there's anything that you have experience with, again, maybe you opened up a Robinhood, got bored one day, started trading some stocks, well, those attributes apply to everything we're going over here. Piercing the corporate veil, this is what I talked about in terms of liability. So the corporate veil, kind of think of a conceptual, like a veil covering the entity. We can pierce it, we can go through it when personal funds are commingled with corporate funds, if the corporation is thinly capitalized, or if it's formed to commit fraud. So as we said, generally speaking, shareholders will not be liable for the actions of the corporation. However, these are in the 3 instances that we need to know for the exam, in which case you can be liable for the liabilities of the corporation. First off, if it was formed to commit fraud, pretty straightforward, right? If you formed a corporation in order to commit fraud and separate it from yourself, yeah, there's no really getting around that. So you're kind of on the hook there. If you commingle your own personal funds with corporate funds, it's essentially like you're treating this corporation as a piggy bank. And the whole essence of creating a different entity is to have that entity do its operations. It's not for you to use it when you want and not use it when you don't want. And thinly capitalized, meaning if it doesn't really have a lot of money, capitalizing through financing, through debt and equity, if it doesn't really have a lot of money itself, kind of hinting at the fact that, yeah, maybe this is like a shell corporation. Now, financing, C-Corps can raise funds through debt obligations, bonds, security obligations, stock and debt, and voting rights. 1 share equals 1 vote. So we can raise money in a various assortment of ways, whether it's preferred stock, bonds, stock, anything like that. Debt, fundamental changes, anything like dissolution, amendments to articles of incorporation, any mergers, consolidations, large scale operations outside of the regular course of business. These are going to be considered fundamental changes. And then fundamental changes do not require unanimous approval. It's not like every single person has to agree, because guess what? Maybe you buy a share of a company when there's thousands out there and you cast a no vote, you screw it up for everyone, right? So how do we approve any of these substantial changes, these fundamental changes? You need to generally just get a majority. That's going to be voting on stock. You may own shares in a company, and every once in a while you get an email saying, oh, there's a big vote coming up, and then you ignore it because you own like 1 share and your vote doesn't really going to matter too much. So with that being said, also, what are your voting rights? Well, generally speaking, the more shares you own, the more voting rights you have. But if there's like a special stock or anything like that, special voting stock, that could be a factor as well. All right. Who are promoters? Well, if you've ever tried to go to a club in New York City and it's not really looking good because you got to pay $100 in cover, that's not what we're talking about here. Promoters, in essence, kind of like people trying to get you to go to an overpriced club in Times Square. Promoters are individuals who take the initiative to create a new corporation or business entity. Kind of think of it like a middleman. Think of it as someone who, again, is kind of like taking the initiative to bring in business. They play a crucial role in the formation process, as they're responsible for organizing the corporation, raising the necessary capital to launch the business. So you can think of these kind of like investment banks. Think of these like organizations that exist to take a cut of the profits, right? Like they help deal with all the regulatory stuff. They deal with drafting the articles of incorporation. It's kind of like that's their business, right? Their business is to get other businesses set up and ready for, let's say, an IPO. Identifying and recruiting potential investors, that's also big, right? I mean, you need a lot of people to raise a lot of money. Negotiating contracts, selecting directors and officers for the corporation. So promoters, if you see that mentioned in the exam, now we know what they are. What is the promoter's liability? So again, think of an investment bank doing all this. So Uber or Lyft wants to IPO. I know they're public. Hey, unless you're listening to this and at this point, maybe they went under or something like that. But Uber and Lyft were private companies. They went public. They likely had an investment bank take them public. That would be the promoter. Now, promoters are personally liable for any contracts they enter into on behalf of the corporation before its formation. Now, this liability does exist because at this stage, the corporation does not have a legal existence and therefore cannot be a party to any contract. As a result, the promoter is the one who is legally responsible for fulfilling the obligations of the pre-incorporation contracts. So that investment bank would be on the hook. Now, novation, we've mentioned this, and you'll see it again. It's just a legal concept, and there's a lot of legal concepts we'll have to memorize and get to know throughout the exam. This is a legal mechanism by which the corporation, once it's formed, can assume the liability for the pre-incorporation contracts entered into by the promoter. In essence, novation is replacing one contract with another. So you had a contract with, let's say, you're furnishing a building to get the office ready for the corporation. Now, since there's no corporation yet ready, right? It's maybe you're just creating the company of Uber or Lyft. So there's no entity yet. But let's say it's Goldman Sachs is dealing with all of the promoting liabilities and all of the tasks required with that. You're building the corporate office for Uber or Lyft, and Goldman Sachs enters into a contract with a construction company to build that office. Well, once Uber and Lyft are IPO and they actually exist, right, the entities are actually formed, then Novation is essentially replacing the original contract that says Goldman Sachs is on the hook for this construction with now Uber or Lyft are on the hook. So that's kind of how that would work. Novation, again, important concept overall for business law, which we will see. Now, this process requires the agreement of all parties involved. I think that makes sense as well, right? You're not going to get anyone on the hook without them agreeing to it. The promoter, the corporation, and the third party with whom the contract was made. Now, once novation occurs, the promoter is released. They are free. They can go fly away from their personal liability, and the corporation becomes responsible for the contractual obligations. Good looking good there. All right, we're going to compare C-Corps and S-Corps. We're going to talk about the overall structure, how this all works. Now, a corporation, it's a legal entity separate from its shareholders, which that's how we have all that liability protection. It has its own legal identity. It's got its own EIN, employer identification number. It's got its, where we have, as shareholders, as individuals, we've got our good old social security number. They can enter into contracts. The corporation can own property, and it will be held liable for its actions. Now, shareholders, directors, and officers generally do not have personal liability for the corporation's obligations or actions, except in cases where they were directly involved in a tort or illegal act. Yeah, that totally makes sense. But if overall the corporation starts dumping in the river, the corporation's gonna be on the hook. You see these stories; they pay a large fine to the government, and everyone goes on their way. No one really goes to jail. Kind of a bummer because corporations get away with a lot of bad stuff. But that is how this is set up. Now, C corporations, it's the standard type of corporation. It's taxed as a separate entity and pays taxes on its profits. Shareholders usually do not pay taxes on the corporation's profits until they receive distributions such as dividends. Now, that you see that maybe a company does not pay a dividend every year. Now, generally in real life, you'll see a company pay a dividend quarterly every year. And why is that? That's just for more so consistency purposes. People don't want to invest in a company with inconsistent distributions. Now, there's some that do that, but hey, that's life. So if the corporation decides not to distribute dividends for 10 years and then pays them all out, on the 10th year, no one's going to get taxed until those dividends are actually distributed. This can result and will result in double taxation as the corporation pays taxes on its profits and then the shareholders pay taxes on the distributed profits. Now, an S-Corp, it's a special type of corporation that elects to be taxed like a partnership. This means that the corporation's profits are not taxed at the corporate level. Instead, they're passed through to the shareholders who then report the income on their personal tax returns. There are significant differences, but for all intents and purposes, think of it S-Corp as kind of like a partnership, but there are a lot of restrictions we'll talk about, you'll have to memorize, in which it restricts it to essentially small businesses. You're not going to see like an Activision, Microsoft, any big company be an S-Corp. That's not going to be how that works. There are certain restrictions, which again, we'll talk about, limitations on the number of shareholders, the types of shareholders, the classes of stock that can be created. These restrictions are designed to keep S corporations as small, closely held businesses. Think of S corps just like LLCs. This was created by the government to help out the small businesses, help them to, kind of survive so they're not held to the same stringent standards and regulations that larger corporations would be, and all of the taxation that comes with that as well. Corporate ownership and management. Shareholders own the corporation, but they generally do not manage its day-to-day operations, which makes sense. Although it would be great if the CEO, CFO were large shareholders, because as a shareholder myself of a company, I'd want those making decisions to also be owners. I mean, that is what would be ideal. Now you see in the real world, a lot of people are career CEOs. They never really own the company themselves. They just hop from company to company, and that's what they do. But if I'm investing in a company, it's a very good sign if the CEO, CFO, those people making the decisions actually hold stock in the company, because it means they've got skin in the game as well. That's just a little side note there. The management power is vested in the board of directors, who are elected by the shareholders. The board of directors is responsible for making important decisions and overseeing the overall operations of the corporation. They, in turn, appoint officers to manage the day-to-day activities of the business, kind of like an indirect democracy, how we have, where we elect officials and then they make decisions for the government, whereas we don't make the individual decisions. Transferability of ownership. A key feature of corporations is the ease of transferring ownership. So you don't think about it, but that may be a significant issue for those other types of entities. It's difficult to transfer ownership. from one person to another. Shareholders can sell or transfer their shares to others without affecting the operations of the corporation, unless there are specific agreements or restrictions in place. Overall, liquidity, flexibility, super easy to raise money, super easy to transfer ownership, sell, mergers, acquisitions, all that good stuff. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.